Worthington with Cross Country Mortgage. Today's topic is mortgage types made simple. So today I am going to first get that out of the way. Today we are going to be going over the different basic loan types. Now there are tons of different loan types that we could talk hours and hours about, but today we're going to talk about the 4 basic loan types of FHA, conventional, USDA, and VA, as well as one other type called a jumbo loan, because these are the main types of loans that home buyers are going to utilize when purchasing a primary residence. So first, let's talk about why loan types matter. That's going to be one of the things we talk about today. And the answer to that is each different loan type is good for each specific borrower. So what one loan type might be good for one borrower, it is not the same for the other. So it matters to understand the different loan types because you want to find the loan type that best fits your scenario. And I'll give some examples as we go throughout this. Also, we're going to cover what is the right loan type for your personal situation, and then talk about some common misconceptions. Examples: one mortgage fits everybody, wait to buy until you can use a particular loan type, etc. So the first loan type we're going to talk about are conventional loans. So what is a conventional loan? A conventional loan is a primary residence or investment, second home, etc. purchase type of loan, and that follows Fannie Mae and Freddie Mac guidelines. The key features of a conventional loan are for first-time home buyers, down payments as low as 3% through the Home One program, down payments as low as 5% for non-first-time home buyers, and no PMI required when you put down 20% or more when you purchase. Again, you are not required to put down 20%, but if you do, the PMI goes away. What is PMI? PMI is private mortgage insurance. It's a type of insurance required by lenders when a home buyer makes a down payment of less than 20% on a conventional loan. The purpose of PMI is to protect the lender against a loss if the borrower defaults on the loan. It does not protect the borrower. That's what your homeowner's insurance is for. The cost typically ranges from 0.5% to 0.6% of the loan amount annually. It's paid as part of your monthly mortgage payment. However, that percentage could go up or down based on your credit score, your down payment percentage, etc. And then homeowners genuinely can request to have PMI canceled once they have reached 20% of their equity in their home being paid off. And then there are more flexible on property types and requirements from the borrower for conventional loans as well. So who are conventional loans best for? So they're really good for buyers with strong credit. Higher credit score requirements are there for conventional loans. So it does have tighter restrictions when it comes to credit scores. So buyers with stronger credit scores tend to be able to qualify for conventional loans. It doesn't mean somebody with lower credit scores can't qualify, but typically that's who it's for. Also, buyers with stable and decent amount of income and assets due to there being, higher requirements for down payment, etc., outside of if you're a first-time home buyer. Also, buyers who want to buy condos. Most condos have to go conventional for the loan type. There are a few exceptions to that, but if you want your full flexibility of condo purchasing, the conventional loan product is going to be the product that you want to look at. And then move-up buyers, right? Buyers that are past their first home purchase and they're looking to purchase again. They've got good equity in the home that they already have, etc. Some pros to conventional loans are lower long-term costs because you're getting rid of that PMI, more property flexibility because all property types are available for the most part to go through conventional loans, and then that the PMI can eventually be removed if you put 20% down or more. Some cons are that there are typically higher credit score expectations. You typically need more in assets saved up to go conventional, and they have stricter debt to income ratio requirements. So debt to income means your total monthly minimum debts obligated on a credit report plus your current mortgage or new mortgage. That has to stay within 48%, typically maximum of 50, but 48% is the standard regulation, which is the tightest of between conventional and FHA, which are the two standard loan types. Now, FHA loans. What is an FHA loan? It's a government-backed loan through the FHA, and it's designed to help more buyers qualify. Some key features are down payments as low as 3.5%, lower interest rates typically with FHA, more flexible credit guidelines, so they allow credit scores sometimes as low as 500, and they also allow the highest amount of debt to income between conventional and FHA. FHA allows around 56% debt to income ratio, so it allows you a higher purchase price capability. This type of loan is best for first-time home buyers most of the time, buyers that are rebuilding their credit, and buyers who don't have as much assets, so lower down payment buyers. Some pros of FHA loans are easier qualifications. They are more flexible with what their rules and regulations are, with allowing buyers to get pre-approved, where conventional is going to be a little bit harder to get pre-approved for. They have lower credit score options, so if you're somebody who's building your credit back up, this is going to be a great program for you. They have lower down payment requirements on multifamily homes. So, for example, with a conventional loan as a primary residence for a multifamily home, the minimum down is 5% or higher, where with FHA, you're allowed to go 3.5%. And the 5% conventional on a multifamily is, even if you're a first-time home buyer, it doesn't matter. 5% is the minimum for conventional. So FHA allows that lower 3.5% down. And they have gift funds are allowed on FHA loans. They are also allowed on other loan types, but FHA tends to be the most open with approval of the gift funds, because you do have to be approved to receive gift funds. It's not a guarantee. Some cons of FHA loans: mortgage insurance is required. It's harder to qualify for a condo, so they are much more limited. Probably, if I had to estimate, I'd say about 90% of loans, condos have to go conventional, and about 10% are approved FHA. For mortgage insurance, it's important to understand, if your down payment is 10% or more, your mortgage insurance premium is going to be removed after 11 years of on-time payments, where with down payments less than 10%, the mortgage insurance is going to be on there for the life of the loan. It doesn't go down automatically, even if you pay on time for 11 years or you reach that 20% equity. So next we're going to talk about VA loans. So what is a VA loan? A VA loan is a loan benefit for eligible veterans and military members. Now, just because you're a veteran or just because you're an active service member does not mean you can automatically get a VA loan. You have to go to your VA and you need to make sure you are approved or qualify for a VA loan. Typically, if you're retired from service, that's through your certificate of eligibility, or COE. If you are currently active, it's through your point statement. Those are what allow you to find out, are you able to qualify for a VA loan? Now, some key features of VA loans that are appealing are 0% down payment is possible, no monthly mortgage insurance, and no set debt to income limits, so much more flexible eligibility requirements. For example, I had a borrower who had a debt to income ratio of 65% get approved for a VA loan, where with FHA it maxes out at 55, like 56, and conventional at 48. Now, who are VA loans best for? They're best for veterans, active duty military, and eligible surviving spouses of veterans. The pros are low upfront cash needed because of that 0% down, so you just have your prepaid expenses and closing costs. Flexible underwriting, so the VA is much more wanting to make sure their veterans get home, so they don't have as strict of requirements on a lot of things that conventional loans or FHA loans do. And excellent affordability for your purchase price that you are looking to purchase. Some cons are that typically there is a VA funding fee. It is an amount that gets financed. It's a percentage based on if it's your first use or not, and based on what your down payment is. You can look it up by looking up a VA funding fee on the internet. It'll pull right up to explain that. But that amount percentage of the purchase price is what gets funded into the loan. So it gets added into your total loan amount that has to be paid back. So there's no mortgage insurance, but you could have a funding fee. eligibility. And then also just understand it is possible for veterans to be exempt from the funding fee, and it would be stated on their certificate of eligibility. Some cons for VA are that the VA funding fee may apply, so it does increase your loan amount. And then you also, it's important to understand that anybody that isn't a veteran, an active duty military, or eligible surviving spouse can't be on a VA loan. So, for example, if dad is a veteran, but son is not, and they want to buy a home together, they can't get a VA loan together with both of them on it because the son is not a veteran. So it doesn't matter if they're a family member, it doesn't count. The next type is USDA loans. So what is a USDA loan? It's a government-backed loan to stimulate rural housing outside of standard city, typically city limits, right? So it doesn't mean it can't be in a town or a city, but typically it's found out in more country, rural towns and cities, not big cities like Cleveland or Columbus, etc. But outside of those outskirts, it, can be. Key features are a big benefit is the 0% down. That depending on where you're looking, you have those geographic eligibility requirements, and then income limits may apply. So it's important to be mindful of that. So USDA loans are best for rural or suburban buyers. There is a website that if you're interested in USDA loans, you can Google USDA eligibility, and you can type in addresses on that website, and it'll tell you if the area you're looking in is in a USDA eligible area or not. Also, USDA does have income limits. So it's important to understand that there is a maximum income you make. And if you make over that, you do not qualify for USDA loans. So they do have, it is more for your lower and moderate income housing incomes. And it's important to know, even if somebody isn't on the loan for income, anybody 18 or over that is having a job and living in the home, we have to count their income in regard to, do you qualify to obtain a USDA loan or not? Some pros are affordable monthly payments, and also your 0% low down payment requirement. Some cons are definitely location restrictions. It is address specific. You could have one house on a street that's USDA eligible, and 4 doors down, it might be outside of that area. And then your household income limitations and rules to qualify are more strict with USDA. It also has the lowest debt to income ratio allowance of 43%. Finally, we talk about jumbo loans. So what is a jumbo loan? A jumbo loan is for people who are looking at your higher purchase price, higher loan amounts that exceed your conventional conforming loan limits. So key features of jumbo loans are they're used for higher priced homes, larger reserve requirements are required, and they require higher credit standards. So a jumbo loan is best for people that are looking at luxury or high cost markets. The pros are ability to finance of larger homes, flexible financing structures. Some cons are stricter qualifications for sure. Larger down payments are often required, and also there tend to be reserve requirements. Reserves are money for your mortgage payments. A certain number of months of reserves are required for jumbo loans. So in conclusion, choosing the right loan, factors that you want to think about to determine the best fit. What your current credit score is, what your debt to income ratio is, what amount of a down payment that is feasible for you, what your monthly budget is for a mortgage payment, do you have military eligibility or not, where is the property located for if it would qualify for USDA, or if it needs to go conventional or FHA, which do not have those address specificities. And then what are your long-term goals? It's important to remember that no loan type is universally best for everybody. It depends specifically on the borrower and what their needs and what they are looking for. So in closing, just remember, preparation matters more than perfection. You do not have to wait to have 20% down and 20,000 extra in the bank. People buy all the time with less funds, right? So remember, you have USDA at 0% down, VA at 0% down, FHA at 3.5, conventional with 3% for first-time home buyers or 5% for non-first-time home buyers. So you don't have to wait until everything is perfect to be able to purchase a home. Buyers should talk with a lender early. Obviously, I am always here to help and would be honored to be your lender. It's important to not wait until you have to move. You want to talk to a lender and do, even if it's a soft check pre-approval, which I've talked about before, to just get the basics down, see if there's anything that you need to work on so that when you're ready to buy, you know you're going to be able to. And then just remember, don't look at homes without a pre-approval. They're going to want that in order to accept an offer. Get pre-approved first to make sure that you can buy the home that you fall in love with. So thank you so much for joining me today. My contact information is below. You can also scan the QR code for my virtual business card. I am available 7 days a week, 8 a.m. to 10 p.m. You can call or text anytime. You can also email me, and you can go to my website, applywithkellyann.com. I hope you all are having a great day, and I will talk to you soon. Bye.